We're talking about Shenzhen and Shanghai today because you have two ETFs there that are debuting today that track Saudi stocks. We're looking at, I think, the CSI 300 is 31%. We should be getting the opening moves in the price of 13 minutes into the session right now. Bloomberg Intelligence thinks the cross-border collaboration will need some time to actually gain some traction between, of course, where you are here in Greater China and, of course, in the Middle East. Senior ETF analyst Rebecca Sin is here with us to talk us through this. So, this is the first, at least onshore play to gain access to the Saudi markets.
So what happened was, you may recall last year, CSOP launched the first ever FTSE Saudi Arabia ETF in Asia Pacific, and this was the largest ETF launch of 2023. Yeah. They gathered roughly $1 billion in assets. A lot of it came from the Public Investment Fund of Saudi Arabia, PIF. And so now this is the second step of the process where they have cross-listed their ETF into Shanghai and Shenzhen. So we have the Huatai Pinebridge CSOP FTSE Saudi Arabia ETF and the China Southern CSOP FTSE ETF. And so this is the second step of the potential Saudi-China ETF Connect or ETF collaboration that they announced last year. So it's backed by political governments. Yep. The PIF governor himself is in Shenzhen right now. For the listing ceremony. And it's a monumentous day because ultimately this means that we're now one step closer to the ETF collaboration between Saudi Arabia and China.
You're saying it might take some time to gain traction. Why? Is it just the geopolitical risks involved? What else?
So with this ETF, there are several factors to consider. The first is performance. The FTSE Saudi Arabia is down 3% year to date. So relative to S&P 500 and Nikkei, the performance is lagging. The second thing that we have in China is the QD problem. And so this is a foreign ETF, so it will require QD. And what we found is that this year, a lot of the fund houses have ran out of QD quota. And as a result of this, some of the ETFs are trading at a 30, 40, even 42% ETF premium because the market has performed so well. Combine that with the fact that the China performance has been poor this year, a lot of investors are flocking to foreign investments. The S&P 500 is doing well, Nikkei 225 is doing really well. And so as a result, this ETF is having to fight for quota within the fund houses. Combine that with the fact of most of the fund houses traditionally allocate to mutual funds because they have a higher management fee. Usually the fee is anywhere from 1% to 3%. This ETF is charging less than 1% in management fee. And so oftentimes the fund houses will allocate the QD quota to mutual funds over ETF. So they have a few factors that are going against them at the moment.
All right, Rebecca, thank you. Rebecca Sin there, our Bloomberg Intelligence senior ETF analyst joining us here in Hong Kong.